Yes, guys and girls, welcome back to another BMO video. Today we are going to be looking at switching fundamental bias. So this is of course quite an important video. You're probably wondering like how and when do institutions really change their views on a currency? For example, you know, HSBC and almost pretty much every single institution was long, like the euro, for example, this year. Why did they suddenly switch their bias? We're going to look at that today. And of course, why did we switch our bias? And I'll put the reasons there as well. But yeah, let's just run straight for it. Remember, it's important to have the understanding of the basics of fundamentals first, because you might be quite confused when watching this video if you don't really understand kind of the way the things work. But of course, you know, this is why you have to stay consistent with your learning curve, right? So always just continue to try and improve and look into everything a lot more. So have that in-depth understanding, if you will. Now, firstly, switching fundamental bias. So obviously there's two types of trades. As we know, there's the we'll call it fundamental swing. I don't know if there's a proper name for it, but you're trading with the fundamentals in terms of where does the overall direction want to be going. For example, we know the markets are bullish the dollar, and you know, any buys you take is that fundamental swing trade. Then we have tactical plays or tactical trades. They're generally known as short-term themes. So something could pop up and markets will trade that in the near term. But as we know, technicals reflects what's happening from a fundamental perspective, both from a fundamental swing trade or tactical plays. This is really important to understand which one are you in, but we'll get into that in just a moment. Now, of course, as I mentioned, trades that go with the data, sentiment, cross-asset correlation, etc. are trading toward. These are known as the long-term swing trades. We'll call it long-term swing trades or just fundamental swings, doesn't really matter. But we know basically if any buys you do on the dollar is known as that fundamental trade because the markets are still long dollars, for example. Next, this is typically the trend, as we know, that the banks want to be trading on a longer-term bias. Understanding the overall trend, so forget about technicals, right? Remember, technicals reflect what the fundamentals are doing, right? So if you can understand why the fundamentals are pushing, you can understand what the technicals are going to be like in 3 to 6 months time, right? So you've probably heard a lot of people say, oh, you can't guess where the market's going to go. You don't know where the market's going to go. Yeah, because you trade technicals. You have no idea what drives currency. But if you understand what the fundamentals are doing, you can understand where the currency may likely go, or the likely push, shall we say, is towards higher dollar or lower dollar, whatever the fundamentals are stating. So that's kind of a very brief overview of what a fundamental swing trade is. Pretty obvious, as we know, just follow what the data is doing. Then, of course, tactical plays. So there's known as trades that play a new short-term narrative. That could be data, etc. It could be driven by a new set of data or a slight sentiment shift. For example, very, very key. I'll give you a live example that we've seen recently. So I am recording this in October 2023. For those who are, of course, watching this at a later stage. At the moment, we are seeing a bit of pound strength, and that's because we had some revision in the PMI data, and the market is now tactically playing the pound higher. And that makes sense, of course, from a tactical play or a tactical trade. They're just driving something. Markets are fundamentally short, so the fundamental swing is being short, but we know at the near term there's a tactical play here, which is of course at the moment being long the pound because of upside surprises in data. Then trades may play off weak set of data that challenges the reasons for the fundamental swing trade. So for example, we know we're long the dollar because we understand growth at the moment is okay and pretty decent, showing upside surprises in its data. However, if data comes in slightly weaker, the markets may sell the dollar in the near term as a tactical play because we understand that maybe they're going to trade maybe the data is starting to turn now sort of a thesis. And that's reasons to get short dollars anyway when we start to see that play occur. But the tactical plays don't tend to last very long. There's no specifics like our tactical plays tend to last 3 months or it lasts 1 month or 2 weeks. It can last as long as it takes. But just understand that if you're trading tactically, that can obviously fall into an eventual swing trade, but we'll have to wait and see. So, of course, like I mentioned, slightly strong labour market data from the UK that may strengthen the currency in the near term because we understand markets at the moment are wanting to be selling pounds because we understand that inflation's falling or has fallen fairly rapidly from a few months ago. Wages have come in weaker now. The employment sector of PMI data is starting to weaken. This again all adds to the narrative that the US or the UK is starting to slow. As a result, BOE should be a bit more dovish, and that's going to be reasons to be selling the pound. But if we have suddenly a strong labour market out of nowhere, but the markets didn't expect that, then what do you think is going to happen to the pound? Because now that challenges that fundamental swing idea of being short the pound. That's why tactical plays are important to understand as well. Then it's important to understand what you are trading or what trade you are taking at all times. And obviously what we mean by that is what theme are you trading? So for example, are you trading the tactical plays, but you know fundamentally you want to be short from a swing perspective. So if you're trading tactically, understanding is you have to get out at some stage, get into the fundamental swing. But also it's important to understand that does the market believe this new set of data? For example, if labour market comes out really strong, you might think, market's going to go tactically long the pound. But if the pound doesn't react to the data to an upside surprise, then clearly the markets don't really care about that. And then you have to think, okay, what does the market react to more? That kind of tells you the thought process. But yeah, that's just an example of a tactical play that markets may take. Now, fundamental swing directional bias. You only switch your bias from long to short when the reasons you are fundamentally short a currency begin to switch. So if we're fundamentally short, let's say Australian dollars, well, we have these are the reasons I'm short, so let's type them out or write them down on your phone or whatever you want to do, how you want to present it. Of course, everyone's slightly different on the way they like to take on information. Write down the reasons you're bearish the Australian dollar. Then, if you're starting to see that switch in terms of you're bearish it because inflation is falling rapidly, now the RBA is a lot dovish. Let's say we have an uptick in inflation in Australia, or labour market is really weak in Australia, but now we have an uptick and the other components of the data, for example, unemployment rates begins to slightly fall, and we start to see PMI data, the employment sector, and that begin to pick up. That's all reasons to maybe we might need to switch our bias because we are bearish for all of these reasons. Now that's starting to switch. It's not tactically yet, or markets may trade it tactically, which, as we know in the short and long-term theme videos, you will see it on the page. It's called short and long-term theme trades. Basically, fundamental swings and tactical plays. Of course, you have to think about, okay, markets may tactically trade a direction, but then hold on to that view if it continues to materialize. So if you're, like I mentioned, let's say bearish Australian dollar, markets tactically go long because now we have good labour market data and China's picking up. They will continue to hold that view until something switches for them to now be short again. Because we know tactical trades are going to go from fundamental shorts, tactically long, fundamental shorts. And the fundamental shorts are more reason or more issues in data that supports the idea of being fundamentally short, right? But if we understand that tactical plays are just going up, burn up in terms of its data, then you may need to consider understanding that you may want to be switching your bias in the near term. Now, it's important to understand what is driving the currency and if that theme is being challenged. So again, like I just mentioned, in terms of the fundamental swings and the tactical plays, is the fundamental swing trades that you're taking and the reasons you're fundamentally short, is that being challenged in terms of data? For example, if you're bearish the euro because growth data is poor, the ECB is dovish, China is weak, and the US is resilient, when you see the reasons you begin to switch, that's when you may want to switch your bias and go long the currency. So, for example, if you're bearish the euro, like what we are at the moment, this is basically the main reasons. Well, if we're bearish the euro, when would we switch? Well, we're going to switch because growth data picks back up. ECB will likely stay dovish because markets are going to be cutting expectations. That's fine. They might push out that in the near term. Let China start to pick up, like we did see. Of course, we had some Chinese data today that was pretty good. Obviously, I'm recording this on the 18th of October. So if you look at, we had a really good GDP figure. That's markets went slightly risk on today. And of course, you are thinking about that US resiliency. So if you're reflecting euro dollar, right, you're bearish euro dollar. If we start to see the US resiliency trade or the theme, i.e. the data in the US is really resilient, really good, basically. If we start to see that begin to turn to the downside, now we start to see unemployment rate rise, for example. We're seeing downside surprises in NFP. We're seeing unemployment claims begin to pick back up. Of course, the higher the number in unemployment claims, the worse, right? That means more people are claiming for benefits, basically. if that's all signs that the employment sector is falling, then growth is going to start to fall. And then you can think you might want to be going now long euro dollar at that stage. So that's just an example of the markets potentially going tactically or changing their directional bias. Now, let's look at some examples of when markets change their fundamental bias. I'll give you 2 examples today. You can do this exactly the same framework. So what you can do after this video is go through G10 or G8. Obviously, G10 includes Norway and Sweden. Most of us don't trade that, so G8 technically, if you want to be by the book. Do what I did, and it can work for you. You might find a better way for yourself. That's fine. But then do this for all the G10 or G8 currencies and go from there. So, for example, Euro switched bias from being long to being short. So, of course, we were bullish. The Euro markets were pretty bullish, the Euro heading into 2023. And then since the end of July, basically, we saw a fairly, big turnaround in the directional bias. Why did that happen? So we're going to look at the examples, and I've put them both on each side so you can just see it from a visual perspective. So firstly, let's look at the reasons we were bullish the euro heading into 2023 and until July, basically. ECB was hawkish, vouching for more rate hikes in the months ahead. As we know, that's pretty good for the currency. European data was okay and steady. So let's say the European data was weak and the ECB is hawkish, then yes, the currency would weaken in that environment because higher rates in a weakened growth environment is going to be bad for the currency because it's going to put more pressure on the economy, basically. But at the moment, the data was okay and steady in Europe. Then we have markets pricing rates higher, which, as we know, is generally pretty good for the currency. So obviously what they were stating there is, based on all the data we're seeing, inflation, wages, etc., we think you can hike 75 basis points more or 50 basis points more. That pricing in perspective, where they thought, previously we thought 25, but now we expect 50, or now we expect 75. That's reasons why the markets were pricing in because of data, of course, and that drove the euro higher. And of course, markets at the time was pricing in aggressive cuts from the Fed because we had a lot of banking issues at the time. We had US data fairly stagnant. And of course, that was reasons for the markets or the main reason was, of course, that banking issue in the beginning of 2023. And of course, the markets were aggressively pricing in cuts. We saw at one stage, right, I think it was around February, where the markets were literally saying the Fed was going to cut in June and July. As we know, that's not happening, or that didn't happen, but that's how aggressive they were literally pricing in because of the sentiment changes in the banking sector, etc. Markets were pushing back cuts from the ECB a lot further back when compared against the US, which then argues for higher euro dollar. What that means is basically, let's say the markets were pricing in cuts for the Fed in August, or not August, they don't have a meeting in August, but let's say September. Then for the Fed, of course, but the ECB, the markets may say, actually, you're going to cut in January. Therefore, why would the markets price in a much earlier cut for the Fed? Well, that would be because of data, and data's weak. And that's, again, reasons to be short the dollar now, and maybe long the euro. And of course, that means euro dollar goes higher. Sticky core inflation argued for more rate hikes from the ECB. So this is all we were doing is just monitoring the data every single week, every single month, and stating, does this still seem feasible? And as we were heading into February, March, April, May, June, of course, towards the end of July, it did seem feasible. And then a big rebound in the current account makes the euro area an attractive region for foreign direct investment, or known as FDI. You might have heard of that term before. Generally, the euro does perform pretty well in that sort of environment, and it's seen as attractive, if you will. So those were the reasons why we were bullish the euro heading into 2023, up until basically July, August, right? So now let's look at the reasons why we are bearish the euro, and you'll notice the theme. ECB is very dovish, and German industrial data turning very weak. Well, the reasons we're hawkish, or the reason we're bullish the euro, is because the ECB was hawkish. European data was okay. Now we're seeing that turning very weak. Growth data was deteriorating quite rapidly. PMI data, employment data, growth data, GDPs were falling fairly significantly, especially in Germany. Components of GDP as well was falling fairly rapidly. US economic data showing upside surprises versus Europe's downside surprises. So now this is a growth divergence. So as we know, reasons we were bullish is because growth data was okay and steady, and the markets were, of course, pricing in very aggressive cuts from the Fed. Well, now we're seeing that basically switch where this happened here. Reasons you're bullish, now reasons we're bearish. We've seen that switch happen. China is very weak and not showing significant rebounding in sentiment. Well, of course, around July, August, China was very weak, wasn't really showing promise. We did have some good data today. Markets did go slightly risk on, but we'll have to wait and see if that does follow through in the weeks ahead. But there was no significant rebounding in sentiment, and the euro doesn't perform well when China is doing weak because of that trade relationship between Germany and China. And of course, the dollar is seen as a safe haven anyway. So when China is weak, that means we're likely risk off, and the dollar rallies in that environment. Higher rates in the US allow markets to be more inclined to be buying US-based assets, creating demand for the dollar. So of course, they will buy into companies because, of course, if they live in Europe, you don't buy into a US company with euros, right? You go to dollars. Well, you're selling euros, buying dollars, you're creating demand for that dollar. Because you have to change your euros to dollars, which when you go to like an airport or you exchange your money when you go to a different country, you're selling your currency to buy their currency. So you're technically saying, obviously we're in the UK, if we go to the US, we will be selling our pounds to buy dollars. So that means technically you're trading GBP USD lower, right? So that's an example of not just markets going and buying dollars specifically or being short euro dollar. They can buy into treasuries. That creates demand for the dollar. They have to change their native currency to US dollars to buy into treasuries and the bonds. So these are just examples of creating demand for the dollar because of higher rates, right? Very attractive. Markets pushing back cuts from the Fed till Q3 of 2024 versus the end of 23 for the first cut. What we meant by that is, as we were heading towards May, June, the markets were obviously pushing back cuts further and further and further. We then got to a stage, I think it was around May time, where the markets pushed back cuts all the way towards December time. But now we then got that pushback even further till next year, till around Q3 now, 24. So that's a significant change in sentiment. And the reason is they're going to push back cuts, as we know. Why would the markets pricing cuts, or why would they push back cuts, is based on the data. Well, if the US economic data is showing upside surprises, both in growth and inflation, then that clearly tells us that the Fed is not going to cut anytime soon. So they push back cuts further into next year, or if we're in 2024, they'll push it back towards the end of the year. And that, again, is very positive for the currency, especially when the markets are pricing in a bit more cuts from the ECB. Of course, that's just an example, or reasons to now be not necessarily more cuts, but pricing in cuts that weren't initially there. Because the markets, I think, roughly 75 to 100 basis points still of cuts from the Fed next year. That can go up, that can go down. It all depends on the data. But let's say the markets expect only 50 basis points worth of cuts, or 75 from the ECB. That doesn't mean you're now being long euro dollar. Obviously, I'll make a video on that, but it just tells us that maybe there's a bit of catch up in the ECB data. All the markets are going to catch up towards the US, for example. We'll only know that if we continue to monitor that European data. But though you can see that shift, right? Hawkish initially for the euro. Reasons we are bullish. Now we saw that massive change. We saw European data was okay and steady. Wasn't showing massive downside surprises. It was pretty okay. And now we start to see that growth deteriorating, showing downside surprises. Markets were pricing in rates higher versus the US. We saw that complete switch happen. They're then pricing in aggressive cuts from the Fed at this stage of beginning of 23. Then we saw that switch happen where they pushed back cuts all the way to the end of 2024. Sticky core inflation argued for more rate hikes from the ECB. Well, inflation is falling in the euro area, but also growth is weak as well. So a hike is not going to be for the right reasons, is it? This is why you have to have that understanding first before we go into this video, is because it's going to be quite alien for you. You might pick up on some stuff, but what I'm saying is you need to have that understanding first of generally what we're talking about. You don't have to have the amazing understanding. I don't have an amazing understanding, but I know what I need to know to understand trading. I'm not an economist. And now you can see that switch happen, right? Where clearly, you saw, I've just compared it. You can see that switch completely happen. And all the markets were doing is just watching the data, and we're slowly starting to see that. That's when we were seeing topping out in the euro dollar, and then the markets, then it just got turbocharged as the markets jumped back onto that theme. And of course, high oil prices will hurt Europe. So obviously that's going to come from a cold winter. So obviously expectations of the current account moving lower into negative territory is because of a cold winter, which is going to be driven by higher gas prices. But also at the moment, we are seeing high oil prices based on, of course, the Israel and Palestine war, which again is a negative thing for the euro in general because they import a lot, right? Now, let's look at the British pound example. We switched our bias from being long, or the markets were bullish in 2023. Why did the markets now suddenly turn bearish the pound around August time of 2023? So let's have a look. So firstly, let's look at the reasons why the markets were bullish. Data surprised the market heading into 2023 and beyond. What we mean by that is, if some of you remember how the pound heading towards the end of 2022 was really weak. The data was really weak. We had a lot of issues with the government. Bank of England was up in the air doing absolutely nothing, struggling basically. And that was reasons why they were massively bearish the pound, which we fair. And then we saw a massive switch where the markets were so pessimistic, the pound, that data continued to surprise to the upside. And that's why they churned from bearish heading in or end of 22 to beginning of 23. They turned bullish. Inflation was rapidly increasing, suggesting more hikes from the Bank of England. As we know, the pound follows basically the rates very closely, right? So if inflation is rising rapidly, remember what you've learned. If inflation rises, what generally happens? Maybe the markets, or maybe the central bank might need to hike again, for example. And that in itself is pretty good for the currency, especially because we saw data as well surprising to the upside. If the data is still really weak, but inflation is rising, obviously that's stagflation, and that pound probably wouldn't have performed as well. But we did see big surprises in data. Wage growth was increasing, suggesting inflation is likely to increase or at least stay at elevated levels. And again, if wages increase, think about it. If you get paid more, you're going to likely spend more. That just naturally happens. So that leads to inflation, right? So that's why wages are very important to consider in your trading strategy or understanding inflation. But wages in the UK were very increasing very rapidly. So the markets were like, inflation is likely to rise quite rapidly as well. So we need to price in more hikes. And that was driving the pound higher. Because remember, the data was surprising to the upside and was okay. It wasn't amazing data, but compared to where we were at the end of 22, it was a night and day sort of comparison. And of course, growth data was held in positive territory for some time. So like, for example, GDP data is obviously in positive territory at the moment, but other bits of data as well, like PMI data. We had good data in terms of claimant counts. We had an unemployment rate was pretty good. So a lot of the growth data and employment data was generally pretty good. And that was a reason why the markets were bullish the pound. Services data or service data was good. UK is obviously majority services based. So naturally, if we see services data, for example, if you look at services PMI data, look at the underlying data within PMIs, you would see like employment and prices. Those were all pretty good. And that was leading to strong pound because we know the UK is services based. They're not going to put too much emphasis onto manufacturing, but services is obviously a bit more of a prevalent thing in the UK. And if that data is good, well, that's another reason to be bullish the pound. And then short-end gilt yield climbing at a fast level, and the pound has followed it higher. So obviously, as we know, the markets, the gilt yields are obviously just the bond or the UK government bond yield. Gilt yield, obviously, we're talking about the short end. So we're looking at a 2-year. While the 2-year yield rise, based on what you're going to be learning in terms of bonds, well, 2-year rise is only going to rise mainly if the BOE is expected to hike more, which, as we know, if inflation was rising rapidly, data was surprising to the upside, gilt yields or short end is only going to climb higher in this environment, and that is going to pull the pound higher, right? Think of it like an anchor. Yields will be doing something like this. Gilt yields were going higher and higher and higher. The currency was like this, and then it acted like an anchor and pulled it, right? And that's when we saw higher gilt yields. So if you get up You'll learn it in the next videos. But if you get up pound versus 2-year yield, or the spread, which you'll learn in just a moment, you'll see it actually follow that very, 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 very closely. And that's more reasons to get long the pound, as we know. So you can kind of see where our thought process is. What's the data like? How is it performing? Okay, cool. What's inflation like? Okay, that's likely to increase the Bank of England. Okay, cool. Yields are pulling higher, which we'll learn in the videos ahead about the relationship. And that is all reasons to get bullish the pound. And of course, the BOE was clear in the language, which reduces the risk of a policy surprise, meaning the Bank of England was saying, okay, if wages increase and inflation increases, we're likely to hike again. There was before, like in 2022, there was a lot of chopping, changing in their thought process. And the markets didn't like that because that pulled out credibility of the Bank of England. But this year in 23, they were pretty clear in what they wanted to do. And that, again, is a reason to get long the pound. So, of course, reasons you're going to be bearish currently. So what do you naturally think? Well, why am I going to be bearish the pound? Well, clearly these things here, the reasons I was bullish, has to start to be switching. So let's just have a look at, since August, basically, why the markets turned massively bearish the pound. Firstly, services PMIs went into contraction territory. I think that was around mid-August. I can't remember the specific date, but went into contraction territory, so obviously below 50. That in itself is not good. If we know the UK is majority service-based, then a contraction in the services sector is not going to be good for the economy. And as a result, not good for the currency. Inflation has rapidly fallen, So, of course, we had a big downside surprise in inflation recently. Not the one that just come out today, but the one before that. We had a massive downside surprise, and the market said, oh, that's another reason to be bearish the pound. And I think that was around September, but that was an extra reason to be bearish the pound. We had 2-year gilt yields has fallen rapidly since around the middle of August, which has acted as an anchor and pulled the pound lower. Well, if we know the reasons the market went long the pound is because yields are climbing, the relationship was still there based on your spread analysis, which we'll learn in later videos. Well, then clearly how you understand where the pound goes is to watch what the 2-year gilts are doing from a cross-asset correlation. So what drives gilt yields lower, especially the 2-year? Well, data needs to start to turn. That suggests Bank of England is either done or starts cutting. We saw that in terms of the data we've seen since August. Well, that's reasons to now be bearish the pound. Wages are starting to see some downward pressure, suggesting that the Bank of England may not need to hike at the next meeting. Again, another reason where we were bullish the pound was because wage growth was increasing, which meant inflation is likely to increase or at least stay at elevated levels. And that means what? More hikes from the Bank of England. We're now starting to see those reasons turn. Well, you're now going to be bearish the pound. So you can kind of see the thought process. It's relatively simple. I think if you write them down, you'd see the comparison. So do it for even nowadays where you're going to say reasons I'm bullish the dollar, write out the reasons. Okay, are we starting to see those reasons now turn? If not, well, there's no reason to get bearish the dollar then, is it? So that's the kind of thought process. Unemployment rate is now starting to rise, or is rising at the moment in the UK. Well, that's generally not pretty good. You know, any higher in unemployment rate is just not good for any economy. So that's another addition, if you will, to be bearish the pound at the moment. And then, of course, we are seeing a more dovish Bank of England because of all of this. So if you know that, if you saw services PMIs was contracting, we are starting to see inflation rapidly fall, gilt yields are now falling, wages has fallen, unemployment rate is slowly rising. Or do you think the Bank of England is going to be hawkish in that environment? No, of course not. They've been very dovish, and they actually held rates when the markets were priced for a hike. And that's when the pound saw a lot of weakness. So you can kind of see the reasons we're bullish it, or the markets were bullish it in 2023, heading into 2020, or not heading into, but like around March, May, January, February time. They switched their bias then, and then of course the pounds rallied very aggressively. And now we start to see that switch. So you can see that physically here today. So you can kind of see, you know, it makes sense, right? It's a lot of sense here. So write them down. You know, you can do the same things for like the Aussie and the CADs and the New Zealand's, for example. But what we can now look at is this. So think. So I want you to think now. what is driving the currency now and the theme of the market. So what is the theme of the market and what is driving the currency? What is the direction of data surprises? So that's very important. How is growth doing? Naturally, if growth is improving, you're going to expect maybe inflation might be higher, or Bank of England or whatever central bank your current or country you're trading. You're likely to see that a bit more on the hawkish side if growth is good. Obviously, on the flip side, if growth is bad, you're likely to see a bit more of a dovish central bank, and that's going to be bearish for the currency. Also, think about how inflation is. Well, they all kind of tie in together. If growth is weak, inflation is likely to be weak as well, or low. Therefore, the currency might see some weakness because the central bank is very dovish, for example, in this environment we're seeing today. That might change in a couple of years where inflation might now be below 2%, for example. Markets aren't seeing inflation, so what's the next theme? And that all drives down to what the theme of the market is. Then, of course, how is employment? They all tie in together. Where if employment's good, growth is likely to be good as well. They tie in nicely with each other. Where if this is good, this is likely to be good as well. If this is bad, this is likely to be bad. If growth is bad, so this is likely to be bad as well, inflation. So you can see they all tie in roughly with each other. Sorry, there we go. But that's just an example of, the market's just completely going and going with the proper direction, right? So these are the questions you have to ask yourself. And then from then on, are they changing? So is the growth changing? So look at the growth data. Is inflation changing? Okay, what drives inflation? Well, naturally, we'll look at CPI and look at wages, look at like the prices perspective of PMI data. That's all reasons to see maybe inflation is starting to change. And of course, employment. So is the employment data, is that starting to, reasons you're, let's say, bullish the currency, is now that start to see downward moves in its surprises. And then that's going to affect growth. And then naturally, that's going to affect inflation as well. Then what you can consider from here is how equity is doing. So obviously now we're going, this is obviously the pillars of FX. So equities, bonds and commodities. These are things you have to consider. You'll learn that in the advanced section. But how is equities doing, which is seen as risk sentiment? Certain currencies are more sensitive to risk sentiment. Certain currencies are negatively affected by risk on, for example. How are the bond markets moving? So obviously what rates are doing. We know the reasons you are bullish the pound was because rates are moving higher. Well, if rates aren't moving higher, maybe that's a reason to be bearish the pound. Why would rates be moving higher? These are the questions. Or why would rates be moving lower? Sorry, these are the questions you have to ask yourself. Then, how are commodities doing? So from an importing and exporting risk, what we mean by that is if oil is moving higher, that's going to be good, generally good for the CAD, bad for the euro, for example, because one, CAD exports a lot of oil. And obviously on the importing side, Europe imports a lot. So does Japan. So CAD yen might pop higher, Euro CAD might pop lower, for example, from a cross-asset correlation. Then, of course, is the currency following this? Is the currency following the bonds? Or is it following what commodities are doing? These are the questions you have to ask yourself at all times, is how are your growth data doing? For the little spider diagram that we just saw earlier, how is that doing? How is the employment data doing? How's inflation doing? How does that fit in with the theme of the market? You then look at cross-asset, because in FX, you don't just look at foreign exchange. You have to look at what equities are doing. So the stock markets, how are the bonds doing, the rates markets. Then from here, you think, how will the currency perform based on these metrics? So obviously, you'll learn how to do cross-asset correlations in a later video, or in the next advanced section. But you can you'd have to do the spread analysis and see what it's following more. Is it following what bonds are doing? The pound is following what bonds are doing. And then you just consider all of this. So it seems like a lot, but I know I agree with that. But if you stay consistent with it, like, for example, you're just keeping up to date with what's happening every week and every month, it becomes a lot easier. If you take a few weeks off and you're chopping and changing, I'm going to look at it every now and again, there's no point in doing it, because you're not going to see success with fundamentals and understanding what really drives currencies. If you're just willy-nilly doing it, you have to stay consistent. So based on everything you've seen, you've learned, understand what drives that currency. So you can do something like this, where you're doing your spread analysis. Reasons you're going to be, let's say, bearish the pound. So obviously this will be over here now. Reasons are going to be bullish the pound. Well, if these aren't switching, there's no reasons for you to be bearish or no reasons for you to be bullish the pound at that stage. So those are just kind of examples of what you would need to do, for example. Now, I just want to do some honorable mentions. Firstly, positioning into data. So how does the currency perform on the run up to important data? So we know, for example, NFPs, how does the markets or how does the dollar move on the run up to NFP? Is it trading higher, maybe pricing in a bit of data? So buying the rumor, selling the fact, short perspective, that's something to consider in trading. Rates pricing. So how does the data determine how many more hikes / cuts are expected? So this is what I was kind of briefly explained before, but if data is really strong, you're going to expect rates pricing to increase, which is going to pull that currency higher, right? Rates are going to expect, or interest rate expectation will rise. Bond yield will follow that, and that pulls the currency higher. So these are just honorable mentions. Next one is, of course, COT data. So commitment of traders data. So how are markets positioned already? Are we at stretch valuations? So you could look at COT data. I know some people like to do that. That's something to consider for sure. I've seen a lot of institutions tail back to this idea for sure about how the markets are very positioned behind bullish dollar bets. So what that means is if we're at stretch valuations already, the bar to beat is very high, which means the dollar is likely to react a lot more to downside moves than upside moves because the market's already stretched to the upside. If we have any more upside data, it's not really new, if that makes sense, because they're already positioned for that. But if we see stretch valuations, this is kind of a live example, but if we see stretch valuations, which we are at, and we have downside surprises in data, then you're going to now see that markets are, oh, we're wrongly positioned. Now let's pull out some of our trades, and that's going to drag that currency lower. Or whatever currency, it's not just the dollar, but whatever currency, whether that's on the stretch to the upside or stretch to the downside. Obviously, if you're stretched to the downside, it's obviously the flip side to that. The markets will basically react a lot more to upside surprises in data than downside surprises. And of course, the next one is what is the currency reacting to more relative to the theme? So is the currency reacting more to inflation surprises or growth, for example? So now just kind of go through all of this and just think, are you tactically long or short trades? How is this doing here relative to the fundamental swings? Are we seeing this switch? Maybe that's reasons to get tactically long, for example. So just go through all of this. Of course, you can read through, watch it again, but just go through and do this sort of analysis here. But we're not finished yet. We have a couple more slides to do. Bias changing. So always ask yourself, are the reasons I'm short or long beginning to change? And if so, does that mean I tactically trade it or switch my bias altogether? These are the questions you have to ask yourself. And to understand this, think about how this new data fits in with the theme and how will it impact the currency over the next 3 to 6 to 9 to 12 months time. This is really important. I just want to mention something is as a trader, right? You have to think what the next theme, I'll put NTI, what the next theme is. Well, if we know before the theme was because how high is inflation, and that means rates are moving higher. That was a theme in 2022. Now we've kind of changed our theme where the theme at the moment is growth. So now markets may have more emphasis on growth data than inflation data, which is the reasons you would be trading this theme up here. So these are just questions you just have to ask yourself. And then after this growth data, what is likely the next theme to be? And then you can see, and you can kind of get in early then into trade and say, okay, cool, growth data is now stabilized. The next theme is going to be, let's say, trade balance data now. It's going to be external factors. Where if we start to see external data in some economies now start to bottom out and pick slowly back up, that's maybe a reason to get long the currency, because the next thing is likely to be this trade data. For example, it could be, it couldn't be. We'll have to wait and see. But at the moment, the theme of the market is, of course, what the what the growth data is likely to be in the next sort of couple of weeks to months time. Now, what I want to show us next is just an example of strategist at HSBC and his kind of reasonings for tactically trading a asset class.
Max, the question everyone wants us to ask, are we still in a window where you think equities can do well?
Oh yeah, 100%.
Until when? How big is that window?
100%. Look, to be perfectly honest, if we think about it, and I know it sounds stupid, but imagine if yields go up. Imagine the 10-year goes to 4.5. What's the reality? The reality is it's probably going to do it because growth is better, right? And because, once again, growth expectations actually turn out to be too pessimistic, right? If you look at Q4 US growth expectations, it's sort of zero. Q1 next year is also close to zero. So the bar to beat is relatively low. So if you get yields moving higher, that's probably in response to growth doing better, so you buy equities. If yields go down, right, then probably rates vol goes down, and then you buy the Nasdaq. So to be fair, yeah, great, I'll just buy equities.
Can big tech still lead, though? And we've seen a recent kind of weakening in the tech profile and an underperformance there. Some people are saying this is the beginning of the end of the tech trade. Are you on that train?
Well, we've heard that for, I think, 15 years. So, it's been a lot of beginnings of the end. Now, look, I don't want to be too cynical, right? But
last year was pretty brutal for the tech trade, let's be clear.
So, but to be perfectly honest, I think tech still has a bit of room to go in the next couple of weeks. There is probably a window around Q4 where I'd be moving more towards really the value side of things, right? Tactically, right? If we get that bump in inflation, particularly in the US a bit higher, you want to probably prefer then for a couple of months things like banks or energy over tech. But for now, I think energy still has, or tech still has a way to go.
As you can see, he has reasons why he's going to be short, let's say, equities. In this example here, of course, he gave the reasons he's going to tactically trade a new idea. For example, he says that bump up inflation is going to be moving more towards the value side tactically for the next couple of months if inflation remains elevated. So you can kind of see the reasons why he's shifting his views in the short term. And that's just an example of course, this is an equities example. You do exactly the same thing for currencies. So if you know, for example, labor market data in, let's say, not Germany, but let's say in the US, for example, well, we know at the moment the labor market data in the US is really good. So if we start to see that fall, what do you think you're going to do? You're going to go tactically short the US dollar because that's not a reason to completely switch the fundamental bias because it's still early days. But if you start to see that data turn, you can go tactically short the dollar, tactically long euro dollar as a result of that, as the dollar leg, for example, because you are trading, remember, euro versus the dollar. So euro dollar is only going to go higher if the euro is really strong or the dollar's and the dollar stagnant. The euro is weak, but the dollar's even weaker, for example, or there's something new to price in for the dollar. Weaker, of course, that pops euro dollar higher, or both at the same time where euro data is really good and the US is really bad. That's the best example. You don't always get it, of course, but we have seen that before actually, not too long ago. But you can kind of see the reasons tactically going into value, because if we see a bump up inflation, and then you'll go away from more of the techie side. Again, like I mentioned, this is mainly equities, but I just wanted to show you that he can switch a reason because something new is coming in. We had inflation falling for some time, but now we're seeing a bit of a run up higher in that inflation narrative. He's now thinking, okay, inflation now rising slightly. What asset classes are going to benefit off this new theme that's developing here? And of course, in this example, he's saying buy value stocks. So that's it for today's video. Hopefully that makes a bit of sense. You can kind of do exactly what I was doing here about, your reasons you're going to be, obviously over here now you're going to put reasons you're bearish the euro, and then reasons you're going to be bullish the euro. And if you're starting to see that switch, and then think about the trades as well, because you might be bearish euro dollar but bullish euro Aussie. So you have to consider also the trade you're taking, because you're going to be bullish euro Aussie, let's say, because Australia is really, really weak, or something's happening in Australia that's bad, and that's bad for the currency. but it doesn't mean, you know, well, that doesn't suggest to you you're going to be bearish Euro Aussie because you're bearish the Euro. You have to look at all of them specifically and individually, and then just compare them all together. But yeah, hopefully that makes a bit of sense. We had a pretty good session today, and I'll see you in the next video.